The secret to building wealth that most veterans miss? Using your VA loan for multifamily properties. I'm Jason Wood, VA loan specialist with over 20 years of experience. Today, I'm breaking down how you can buy a duplex, triplex, or fourplex to start creating wealth through real estate. Using your VA loan to purchase a multifamily loan is one of the smartest strategies that any veteran can use to start creating wealth. Today, I'm going to break down all the steps and things that you need to know on exactly how to purchase a multifamily home using the awesome tool of the VA loan. Let's get started with just the basics. The VA loan allows you to buy a multifamily property up to 4 units. You can buy a duplex, a triplex, or a fourplex with the VA loan. There's 0 down payment. There's no private mortgage insurance. Interest rates are going to be anywhere from 1/4 to 0.5% lower than a comparable conventional loan. And you have the same VA loan guarantee as you do on single family homes, which means the VA is guaranteeing 25% of this loan to the lender, which makes you a lower risk. The key requirement is you must live in one of the units as your primary residence for at least 12 months before you move out. After that period, you can move out and keep renting the entire property, but it's important you remember that one of the units must be occupied by you, the veteran. This is a unique advantage that the VA loan has over other loan products out there like FHA or conventional, because both of those loan products are going to require you to have a down payment, anywhere from 3.5% up to maybe even 25% down payment, depending on the specific scenario. And USDA loans, they don't allow multifamily homes. Let's look at what this means in real dollars. Let's take a $500,000 duplex as our example. It's a VA loan, so we're going to do 0 down payment. The FHA loan would have had a 3.5% down payment. That's $17,500 down payment. The conventional loan is going to require at least a 5% down payment, which is going to be $25,000. The ability to purchase with 0 down payment makes purchasing multifamily properties very accessible for veterans, where some of the other loan programs, because of the down payment percentage and the higher purchase prices of these properties, might make it impossible. Qualifying with rental income. One of the most amazing benefits to the VA loan program when buying multifamily is you can use the rental income from the other units, the one you're not occupying, to help increase your qualifying income. This is especially important as you're looking at these properties, which are typically higher priced than a traditional single family home, which is going to require more money to qualify. The benefit is we can use rental income to help you get there. Now, we're able to use 75% of the rental income, and the rental income can be depicted through a couple of different ways. Number one, if there is a current lease on the property, then we're going to use that number. If the unit is vacant, then we're going to use rental projections from the appraisal report. And then the appraisal itself will obviously have rental projections as well as part of the comp analysis it does. Just like it provides comp analysis on value, on a multifamily purchase, there's going to be another section which does comp analysis on rental income. In all of those situations, we have to use the lesser of, whichever is the lowest. Typically, an existing lease is going to be lower than what current market value states rental income is. But in the instance that the unit is vacant, then we do get to use the current market value. Where some people get tripped up is they're looking to buy a property where the tenants have been there for many, many years paying a low rent. They're thinking they can buy it, charge everybody today's current market rent, and qualify off that current market rent. That's not true. We have to go off of the lesser that's being received or the lesser that's being analyzed by the appraiser. So let's say you're looking at a $400,000 duplex, and the duplex rents out for about $1,800 a month for each side. If we're going to use 75% of that $1,800, remember you're living in one unit, we're going to rent the other one out. That other one's going to rent for $1,800. For your qualifying, we can use 75% of that $1,800. That's $1,350. So your income, we can basically stack another $1,350 on top of that to help you qualify. So if you're making $5,000 a month from your job, for purposes of qualifying for this loan, we're now looking at a qualifying income of $6,350. The additional qualifying income is what can help you scale and purchase a more expensive home than you would be able to qualify just on your own. And like I mentioned, sometimes these multifamily homes are going to start out at a higher price point than the average single family home. So in some cases, it may be a necessity to get that rental income to help you jump up into that higher purchase price zone. I recently worked with an Army veteran in Colorado Springs who wanted to buy a triplex for $500,000. On his own, with his retirement and disability income, he didn't qualify for the home. But once we were able to include the rental income in there, we were able to get him approved. Now, how do you find the right multifamily property? It can take a little bit of strategy, and there's some keys to finding the right property. Let's walk you through what those keys are. Location is crucial, right? We've heard about the 3 L's of real estate: location, location, location. Look for properties with strong rental demand, low vacancy rates, and good appreciation potential. Being near a military base, a hospital, a college, or other big employers can be a really good key indicator of the ability for you to get that property rented and get good income from it. Property condition matters. The VA loan has the minimum property requirements, so the property does need to meet those specifications at the minimum. But a lot of times, some of the multifamily homes can be older homes, so there could be some deferred maintenance or just some updating that hasn't taken place over the years. It's my advice that you spend a little bit extra on your home inspection so you know exactly what you're getting into and what you might have to overcome in the future with that property. Unit mix considerations. What I mean by that is how many bedrooms are in each unit. You know, in some rental markets, a 1-bedroom unit might rent out more quickly than, say, a 2-bedroom or a 3-bedroom unit. In other markets, it might be the opposite. So it's important to understand the market that you're going to be purchasing in so that when you're looking at multifamily, even though the numbers might look good, to make sure that you have the right unit mix within there so that you can always maintain a high occupancy rate. Separate utilities can be another really important one, because if you have separate utilities for each unit, then the tenant can pay their own utility bills, therefore increasing your cash flow. Management requirements. Consider how hands-on you want to be as the property manager. Would it be better off for you to be hands-off and have somebody manage the property for you? That's something to determine yourself. But remember, you're going to be living next door to your tenant. So sometimes having that property manager might be the best buffer zone you have, because your neighbor might just think you're another renter and not the owner, which may alleviate you of those 2 a.m. calls for a drip in the sink. Working with a realtor who understands multifamily and VA loans is essential to you having success in acquiring a multifamily property using the VA loan. I can't tell you how many times I've come into a transaction where one or both of the real estate agents are unfamiliar with multifamily, or they're unfamiliar with VA loans in combination. It makes it very challenging, and in some instances can almost prevent you from buying the property that you want because of that lack of experience. A lot of real estate agents focus solely on single family properties, and some agents focus solely on multifamily properties. What's important is to make sure they understand VA loans and multifamily properties. That's a unique mix. Cash flow analysis. So let's walk through that. It's important to understand what the cash flow is going to be and how much it helps to offset your proposed mortgage to help you determine whether or not this is going to be a positive purchase for you or not. So let's take a $400,000 duplex at a 6.5% interest rate for our example. Your monthly principal and interest payment on that would be $2,528. Property taxes, about $400 a month. Home insurance, around $200 a month. Makes your total monthly payment $3,128. Now let's say the other unit rents for $1,800 a month. You're living in one unit, the unit next door rents for $1,800 a month. So your mortgage payment of $3,128 minus the $1,800 you're receiving in rent will leave you with a net mortgage payment of $1,328. Compare this to renting a similar unit yourself. What if you went and rented something for $1,800 per month? By owning this property, it would actually save you $472 in comparison to going to rent your own property. And on top of that, you're building equity and you have great tax incentives. But we also need to account for some other expenses. We need to account for a vacancy rate. I suggest a 5% vacancy rate. That equates to about $90 a month. Repairs and maintenance, figure another 5%, about $90 per month. And capital expenditures of about 5%. Which is another $90 per month. So this brings your true monthly cost to $1,598. This is still a good deal compared to renting, because now you also have the potential for appreciation, gaining equity, on top of the tax advantages that you gain as well. It's important to look at all these costs, because a lot of first-time investors don't know to look for these things, and overlooking them is going to impact you on your long-term cash flow. I worked with a Navy veteran who purchased a triplex in Virginia Beach. With the rental income from the 2 units, the Navy veteran's total housing expense every month was only $350. This is less than 20% of what he would have paid in rent. So what this really does is it sets him up now to become a monster saver, because his out-of-pocket for housing is so small that the money that he's bringing in every month, instead of spending it on the house, he can really save for the next real estate investment. Let's talk about the VA loan requirements for the multifamily home purchase. There are some specific requirements for the VA multifamily home purchase, and this is important. A lot of this stuff is hard to search and find answers to on the internet. Occupancy, touched on a little bit earlier, but this is super important. Any VA loan, no matter what property it is, must be a primary residence. So if you're buying a duplex, a triplex, or a fourplex, one of those units you have to occupy. That's the rule with the VA loan. and you have to occupy it within 60 days of closing. There can be some exceptions to that, but typically you have to occupy within 60 days of closing, and you need to stay there for at least 12 months. Property requirements. Now, all of these units have to meet the VA's minimum property requirements, meaning they have to be free of any health or safety concerns, be structurally sound. They have to have a heating element and a cooking element in them as well. Loan limits. VA loans don't have loan limits. So if you don't have any outstanding entitlement, you don't have a limitation on the height. You don't have a limitation on how much loan you can borrow so long as you qualify for it. What can be confusing and where a lot of lenders stumble and trip is they will pull the county loan limit form online from FHFA, and on that Excel sheet, it shows single family, duplex, triplex, and fourplex. The inexperienced lender is going to go to the column for the property type you're selecting. So if you were looking for a triplex, they're going to move over to that column and say, okay, well, this is the limit. They couldn't be more further from the truth. The VA doesn't recognize those other columns for county loan limits. It only recognizes the single family home county loan limit regardless of the property type that you're buying. But like I mentioned, if you don't have an existing VA loan stuck on another property, then there is no limit for you. In the instance where you do have another VA loan, an entitlement stuck on another property, but you still want to purchase this multifamily using your VA loan, well, now we have to look at that single family home loan limit for your specific county as a part of our equation for determining your new entitlement number. The property should be self-sufficient, meaning it has its own kitchen, its own heating source, its own bathroom, and its own entrance. Additional documents that you might need to provide would include lease agreements on the current property, a rental market analysis, especially if we have a vacant unit or more than one vacant unit on that property, and landlord experience. Now, here's where it's going to be important to work with a lender who knows VA loans with multifamily very well. When you're looking to purchase a multifamily home and you're going to use the rental income to help increase your qualifications, there's two other steps that we have to be conscious of and we have to meet. Number one, landlord experience. VA states that you must have at least 12 months of prior landlord or property management experience. Now, the exclusion or the way to get around this is once we're in contract on buying the house, if you contract a licensed property manager to manage the property for you, we can now get past that requirement of having to have at least 12 months in your past with that type of experience. This can be actually a really big benefit. Even though there is a cost to having a property manager, I've had many clients who were apprehensive about it because they were so focused on the monthly cash flow that they were a little bit upset having to give up a sliver of that to a property manager, only to find out several months later it was actually a huge benefit because their neighbors in their fourplex or triplex just thought they were another renter. So they were never being bothered as the owner to help fix things, negotiate things. And when it came time for rent and it wasn't due, the owner didn't have to go knock on the neighbor's door. The property manager went and knocked on their door. So it gives a really nice buffer between you as the owner and the tenants in that area. Now, the other thing that we have to always accomplish and make sure exists in your loan file, if we're using the rental income to qualify, is we also have to have reserves. You may have heard this. So what are reserves? Reserves are the requirement of 6 months of this proposed mortgage. So we're going to buy a triplex. We have a proposed mortgage. That number times 6 is how much money you need stashed away somewhere. It can be in your thrift savings plan. It can be in your Charles Schwab account. It can be in your savings account, your checking account. It could be spread amongst all of those accounts as long as the grand total equals 6 months of this new proposed mortgage. The reason for that is the VA knows on your own, with your own income, you don't qualify for this home. That's why you needed the rental income. So they get that. But because you need this money to qualify, what happens, worst case scenario, if everybody walked out on you tomorrow and you had no renters? Could you manage the payment for a period of time until you got the place reoccupied? And that's what the requirement for the reserves is for, just to provide that safety net on a worst case kind of doomsday scenario. One of my favorite examples was an active duty Air Force member up in the Sacramento area. And this was back during the pandemic. So you got to remember interest rates were crazy low. But we were able to actually negotiate the seller to pay all of his closing costs. He bought, I think it was an $880,000 fourplex. We needed the rental income to qualify, but he was a good saver. So he had money in his thrift savings account. We didn't have to liquidate it. We didn't have to touch it. We just had to show a statement showing that he had enough money in there. And because of the rental income from the other 3 units, and he was able to get the incredibly low rates that were available back in that time, he had no mortgage obligation. The rental income from the other 3 units covered his entire mortgage payment. Now, our strategy together was, okay, great. Now you're going to have this monthly BAH that you receive. Your mortgage is being paid for by the tenants. What the plan is to save every penny of the BAH. All of that is going into savings so that after he's hit the year mark or it's time for him to move, he now has enough saved up in down payment to go use either an FHA or a conventional loan and buy another multifamily property. He's young, no children yet. This works perfect for him and his family situation, and they're going to be able to exponentially grow the real estate portfolio with rental income properties because they were able to establish this and are dedicated to saving that extra money that otherwise would have been spent on a housing obligation, whether it would be rent or a mortgage. And that's part of the long-term strategy of how you can really grow wealth using the VA loan and using multifamily homes as a way to do it. By living in one unit and having the other units be rented out, the money you're saving each month from the rental income as compared to what the full mortgage would be, if you can be diligent about saving that money, that will become the new nest egg for the down payment on the next home. And we can use other financing type. Maybe we can use the VA loan again, or we can look at a conventional or an FHA loan, depending on what's going to be best for your scenario to pick up the next multifamily home. Growing with multifamily is going to increase the amount of doors or renters that you have paying you rent each month. So fast forward 15, 20, 30 years when this home is paid off or nearly paid off, obviously over that amount of time, rents will have inched their way higher and higher. So your cash flow is going to be better. If there were refinance opportunities during that period of time, which there probably were, to reduce that payment, now you've just grown that spread on your cash flow. So you're cash flowing even more. And now you hit like real retirement. You've retired from the military. Now you've retired from your civilian job. You're picking up military retirement, your disability rating, maybe retirement from that civilian job that you did after the military. And you've got all this real estate that you've acquired with people paying you rent. Some of those loans might be paid off, but regardless, you've probably got a mountain of equity that's been created over all this time because other people were paying your mortgage for you, and the market naturally over time increased. So now at full retirement age, not only do you have good income sources from your jobs, the income coming from the rental properties is significant as well, but now you have equity options, right? You could sell it all and go invest in a big apartment building. I mean, there's so many different options that you have at your disposal. It just gives you so many options, but will generate a lot of wealth for you and your family. Now remember, the VA loan is not a one and done type of thing. You can reuse your VA loan multiple times. So there's ways to do this. One of the ways to do this is to purchase with the VA loan, fast forward a few years once some equity is built up, refinance that home before you move out. So while it's still your primary residence, refinance that into a conventional loan that will restore all your entitlement. Now you can go buy the next home at the next duty station with zero down payment again. The other thing that you can do is you can sell the home. That would restore all your entitlement as well. Or we could use the VA loan one more time or two more times, depending on how much entitlement is left and those entitlement calculations to buy another home. I have several clients with 2 existing VA loans. I have a few clients with 3 existing VA loans. So it's absolutely possible, and just depends on the numbers, where you're buying, what those county loan limits are at the time that you're buying. And you could have more than one VA loan at a time. So I personally believe that using the VA loan to purchase a multifamily home is the absolute home run swing when it comes to using the VA loan. It's a massive opportunity to start creating wealth. And if it works, if a multifamily home works for you and your family in the location where you're at, because you got to remember, there's some areas of the country where there's just not a lot of options for multifamily, and other areas of the country where they're plentiful. So if it works out, I think it's the home run swing. There's a ton of benefits, which we covered a lot of those in this video already, but let me run them through one more time. You can purchase with zero down payment. You can live in one unit while you rent the others out, offsetting your mortgage payment greatly. That will help you increase your savings. You're going to be building equity the whole time while you live there and even afterwards, because the tenants are paying the mortgage for you. They're paying that balance down for you, and your home is appreciating slowly over time. And you're ultimately creating a foundation for future real estate investments, because that mortgage payment has been offset so greatly, you can now save and use that to apply as down payments on the next real estate endeavor. If you're looking to explore this strategy, I love this strategy and would love to help you analyze your situation. So click the link below to schedule a one-on-one appointment with me, or visit me online at valoanguy.us. If you found this video helpful, give me a like. Would love to have you subscribe. And by all means, share this with everybody you know, because more people need to know about the VA home loan and creating wealth using the multifamily loan. Aim high.